Hey everybody, how you doing today? It's Friday, June 17th, 2022, and here we are for another episode of our investment wealth blog. I want to start today's show by saying thank you to the people who came out in such numbers yesterday to support our efforts here. I want to thank Greg Manarino for putting it out to all of his subscribers, Jordan Dove as well, but especially to the Manarino community. The outpouring of support, genuine caring about somebody you don't even know's success. The amount of people that responded with comments and questions and likes and subscriptions. It's just an amazing thing, and it's something that you guys can all be proud of, being part of a community like this that gives it support to help other people like you guys did yesterday. It's just I gotta say, it's just an incredible thing, and I feel incredibly grateful and blessed to be part of this with you guys. It just makes me want to double my efforts to do the very, very best I can in giving you guys practical, good advice on how to start, grow, and build wealth, how to have a good, prosperous, and happy life, and all the things that are important to having a successful life on this earth. Again, it's just a staggering amount of support, and I can't say thank you enough times. Okay, so let's get into this market today. In my view, nothing's really changed overnight as far as what I see coming as far as this recession. The president was out yesterday and some of his supporters talking about that it's not inevitable we're going to have a recession, and even the Fed was kind of supporting that stuff. Please don't believe that. I tell you right now, believe it, we're already in a recession. Now, the definition of a recession is a pretty simple one. It's 2 consecutive quarters of negative GDP growth. We've already had the first quarter of this year negative, although not gigantically. And I believe that when the report comes out in July for the second quarter, we're going to have our second consecutive quarter of negative GDP, confirming we're already in a recession. And this recession is just now starting to gain steam. You know, gas prices, at least where I am in Las Vegas, are not coming down. They're stuck, or they're going up. There hasn't really been any relief, pushing the number back down to $5 a gallon. So it's coming, guys. So let's do what we have to do to get ourselves in the best possible position we can get in to not only survive this storm, but to thrive, especially after, with the opportunities that will present themselves. Now, the market today was mixed. The Dow ended up with eking out a small loss. The S&P and the NASDAQ had a little bit of a rally. Nothing certainly to write home about. Gold and silver were pretty much flat. So was the 10-year today. It's just really pretty much a non-eventful day, which after the events of yesterday and the few days before it is welcome. Honestly, I thought it might be a little bit worse today than it turned out to be, because I thought a lot of these traders might want to unload positions before the weekend comes, just to make sure they don't get caught flat-footed if there's any bad news coming out over the weekend. I want to take a second today and talk about cryptocurrencies. I know a lot of you guys who are following Greg are invested in crypto. Crypto, in my opinion, started out as the great equalizer. It was something that regular working people, the schmuckatellis of the world, could, get involved in and realize some gains and have a real shot at legitimate wealth. I guess, I don't know the exact statistics, but Bitcoin and a lot of these cryptos have made a lot of millionaires. But now, as it's winding down, it's starting to look, at least to me, a little bit more like a multi-level marketing or some kind of Ponzi deal, where it's like, look, this guy made millions of dollars, you can too. And it always turns out that the guy who makes the money is that guy making millions of dollars. So I would tell you, I don't want to sound completely negative, but my thinking is we want to get ourselves into a defensive position. I'm not sure if something as speculative as cryptocurrency fits the bill for the coming, during this coming recession. It's looking like there's not a lot of support. I'm sure it'll bounce. I'm sure that real money will come in after they wash out the little guy and maybe pump it back up. But I just think it's something. There's other places to look for yield and for gains, and that are not as speculative and don't have that same level of risk of decline that you see in cryptos. If you look at the chart for those, and I'm not suggesting anybody listening to this podcast or this blog, become any kind of chartist. That's what I do for you. But the chart just looks horrifying. You can see the trend up all the way, and now you can see the trend right back down all the way. And the same with, I was looking at the S&P 500 2-year chart today, and most of you can get that right on your phone. Have a look at that. It's starting to look like a mountain now, where it's like, and then check it out. It's just amazing. So all the things that I've been talking about in my brief, and that Greg's been talking about, and some of these other people who are pretty wise as far as investing in money, it's all coming. It's all happening. There's no denying what the reality is anymore. So now it's time to take action and do something about it. Yesterday we had so many people commenting and asking questions in the comments. I'm just so excited about it. I actually had my assistant print me a whole bunch of your guys' different questions so I can answer a few of these before we break for the day. But one of the things that I was asked to talk about was real estate and why it's going up like it did, and what the future looks like for real estate, in my view. It's just been a very quiet thing happening that most people aren't aware of. Now, everybody that's watching this has probably heard the saga of Elon Musk and his Twitter. He's going to buy the company out for $44 billion. The only reason you know about that is because the SEC requires you, when you acquire a certain percentage of the shares of a publicly traded company, to file what's called a 13D, just one of their regular forms. But that 13D is very important to the market because on that form you have to declare your intentions. Are you a passive investor? Do you intend to acquire more stock? Do you intend to try to get a seat on the board? And all kind of different stuff you have to answer, and it becomes public information. So that's why we've all heard about Elon and all these other takeovers, because when they get to that threshold, they have to report it. Real estate is not reported the same way. So what we've been having is a very quiet takeover, for lack of a better word, by all the Wall Street guys, the VC guys, the private equity guys, the hedge funds, and they've been in this real estate market across the country, and they're buying up everything they can get their hands on. And these guys have a lot of bullets they have a lot of money, let's just say that. We're talking Blackstone Group. They have over $600 billion under management. A lot of their latest moves have been in real estate. Matter of fact, they are now the largest landlord in the state of Nevada. They own all the hotels on the Strip. These casinos came up with this wise move of, well, we can sell the property and then lease it back, and then we can create money that way to invest, blah, blah, blah. Well, who would you rather be? Would you rather be Blackstone, who owns the Bellagio and the property, and where it sits on Las Vegas Boulevard? Or would you rather be MGM, leasing that property from them in the hopes that we don't have a recession like this? Because I'm telling you, it's going to be crazy. Now, how are they going to pay their leases and make a profit when the recession comes? How's it going to work? They're going to be begging these landlords for concessions, and anybody that's ever rented anything is going to know they're probably not going to want to cooperate too much. And it's not just Bellagio. They own the private equity guys pretty much own them all, Blackstone being the biggest. They also own more than 25% of the apartments across the country. So they're hogging up the rental space. They own more than 15% of all the single-family homes in the country. So it just is this giant mammoth wave of money, and very quietly they're taking over the entire real estate market. They're going to have so much leverage and so much strength. They're going to be able to control the market. They didn't care about overpaying for properties because it was driving up all the comps on all the other properties they own the same time. So if you overpay for this one, but you get a giant bump in valuation on these other 300 properties you own, fair enough. So what they did in essence is froze the little guy right out of buying their first home. First time home buyers in this market here in Las Vegas, and I'm sure it's the same in a lot of higher priced neighborhoods in this country, they're literally shut out of the market. So they face the prospect of a few choices. They can live with their parents. They can go rent an apartment. A one-bedroom apartment here in Vegas is averaging about $1,850 a month. Or they can do what? There's nothing else. They can't buy a house. Rates are so high, the payments are staggering. They can't qualify. And it is where we are in the real estate market right now. As rates continue to rise, it's only going to further shut these people out of the market. Now, I had my handy dandy mortgage calculator out earlier today, and I was working out some numbers. So here in Las Vegas, the median price for a house is roughly $450,000. I think that's kind of high for this neighborhood. Vegas is a working man's town. We're a casino town. We're not high tech. We're not California with their movies and all the other industries there. This is just a blue collar town. It's all built on service and the casinos on the strip in downtown. The numbers are unsustainable for the people working at those places. They can't afford to buy a house. Now, I calculated it out. If you bought a house today at the median price of $450,000 and you put down a 5% deposit or earnest money deposit or down payment, whatever, that's $22,500, which a lot of people can't muster up. But if they could, even with all of that, you're looking at a payment of around $3,300, $3,400 a month. So I was like, okay, that's not going to work. So if $450,000 is too much for people to finance a house, what does the number have to be for a payment that makes sense? So my first calculation was, let's just take it down to $350,000 and see where that fits. Well, if you take the same calculation, a $350,000 house with 5% down at today's prevailing rate, which is about 6%, you're looking at a payment there of $2,300, $2,400 a month, depending on taxes and insurance. And I really still don't believe that's sustainable. The median household income here in Southern Nevada is around $60,000. I don't know how anyone who's talking with people about money has any kind of fiduciary responsibility can recommend that to a customer. So I think that what we're going to see here, guys, is property values are going to, I think the median price in Vegas is going to come down all the way to $300,000, which will make houses affordable for the first-time buyer and people who are just getting into the market. And it's going to be really, really bad. What's happened is you've got people who are having difficulty just paying the necessaries of their life, their mortgage, their food for the family, gasoline in their car, everything's going up. Even cable TV and all the stuff that always goes up anyway, they're taking advantage of the situation to raise rates. So these people are stuck, they can't pay. And now finally, the last final coup de grace, they're going to wipe out a ton of their home equity, if not all of it. And we're going to see the same kind of phenomenon we saw back in 2008 and 2009, where people are upside down in their houses. They owe more than the house is worth. Like I mentioned yesterday in my video, there's just not a lot of scenarios where we come up with happy endings. Anyway, I've been windbagging a long time today about these topics. I appreciate you guys taking the time to come out and listen. I did want to get to a couple of quick questions before I go today, though. One of the questions was, what's your take on real estate? You've already got there. A person said that they're in several commodities and trying to buy more. And they asked for my take on oil stocks and oil and gas ETFs that they've already owned. And I'm guessing you might have got recommended to by Greg. I tell you, these are a hold. And maybe even a little bit, if there's dips, depending on why the dip is, these are a good idea to hold into your portfolio and to even add a little bit too. I think that You know, every commodity is priced in dollars. As the dollar strengthens, typically so does the price of the commodities behind it. So I think that would for sure be at minimum a hold, and on certain dips might be a little bit of add just a little bit to your portfolio. This viewer sent me and he said that how would I handle my senior citizen parents who are fully invested in the market and think their money guy is wonderful? Well, I would have them just ask their money guy what he's done to hedge their portfolio or protect them from big losses in the event that there is a correction in the market, in the event there is a recession. We understand that he's probably giving them, you know, glowing stories of don't worry, this is a great buying opportunity, which they always seem to pull out, right? Have them, rather than you trying to convince them, I would try to talk to and have the broker they trust convince them. I think that would probably be the easiest way to get them to actually do something with their portfolio. When you say fully invested, I understand what that means, but it doesn't really give me much information on what they're invested in. So you want to have that broker go through that portfolio and kind of advise them on some of the stocks that are in that portfolio or mutual funds that would be more at risk in a recession, some that would be maybe do well in a recession, because I think, you know, funds that pay big dividends, preferreds, anything that has big yield where you're actually generating a return every year, dividend or interest or whatever, reasonable, I think those are going to do very well. So tell your folks to at least have, if nothing less, review the portfolio with their broker and make sure that it's all in order as he thinks it should be for this time. He also mentions in there that they have insurance. What does insurance do for them? I'm not exactly sure what the nature of the question is. What kind of insurance do they have? You know, I don't think, at least not to my knowledge, there's portfolio insurance where if your portfolio tanks, that an insurance company is going to step up and pay to make it whole again. I just don't think that exists, but I could be wrong there. I've never heard of it. But the best insurance they can have is to hedge their portfolio, get themselves in a defensive posture like I've been insisting everybody that's been listening to this for the past couple of days do, and hunker down. Because at the end of it, the opportunities are going to be there for all of us to really make some gigantic scores. Anyway, I appreciate you spending the time with me today. Again, I want to say thank you so much for the support you guys gave in my initial post yesterday. It was just an amazing thing. I really appreciate it. Again, I suggest in closing that you ask me questions, comment, like, share, and if you haven't already, subscribe. We plan on putting one of these videos out every day shortly after the close of the market. Hopefully it'll be something beneficial to you and you can use to start, build, or protect the wealth you have. Have a great day, guys, and a great weekend. See you soon. Thanks.